At 11:47 a.m. on December 23, 1913, in a hushed chamber of the United States Senate, a clerk's hand moves across parchment. The Federal Reserve Act. 600 pages of dense legislative prose. Carter Glass sits 3 rows back, watching. His face reveals nothing. Around him, senators debate gold reserves and discount rates, their voices echoing off marble walls. But Glass knows something they don't. Buried in Section 13, Subsection 2, a single clause he drafted 6 months ago in a Richmond hotel room. 17 words that will quietly dismantle a century of financial architecture. No one in that chamber understands what they're about to unleash. Not the progressives who think they're finally breaking Wall Street's stranglehold. Not the bankers who believe they've preserved their power through compromise. Not even President Wilson, who will sign this bill into law in 4 hours, fully grasps the mechanical elegance of what Glass has built. They see a central bank. Glass sees something else entirely, a modification so subtle it will take 2 decades for opponents to realize the game has fundamentally changed. By the time they do, the old system will already be dead. Act 1. The system that kept failing, October 22nd, 1907. 2:14 p.m. The Knickerbocker Trust Company, New York City. The line stretches 4 blocks. Men in wool coats, women clutching handbags, all pressing toward bronze doors that won't open wide enough. A woman near the front faints. No one stops. They step over her. Inside, 3 tellers count bills with shaking hands. Behind them, the vault door stands open. Inside, empty shelves. The Knickerbocker held $62 million in deposits yesterday. Today, $8 million remains. By sunset, it will be 0. This is the 3rd major bank run in 2 days. Tomorrow, 12 more institutions will lock their doors. By week's end, panic will consume every city east of the Mississippi. And just like the previous panics, 1873, 1884, 1893, 1903, the American financial system will have no mechanism to stop the hemorrhaging. No lender of last resort, no emergency liquidity, no central authority to inject currency into a system choking on its own fear. What America has instead, clearinghouses, private associations of banks operating in major cities, supposedly designed to manage crises through collective action. When panic strikes, member banks pool their reserves, issue clearinghouse certificates, essentially paper IOUs, and hope depositors accept them as temporary substitutes for real currency. The theory sounds elegant. In practice, it's a doctrine held together by reputation and luck, and it keeps failing. The technical flaw is simple but lethal. America's money supply is completely inelastic. Every dollar in circulation is backed by physical gold or government bonds. When harvest season arrives and farmers need cash, there's no mechanism to increase the currency supply. When exports surge and businesses need credit, the money stock can't expand. The system operates like a cable pulled taut. Any sudden stress and something snaps. During the 1907 panic, the clearinghouses deploy their standard playbook. J.P. Morgan himself locks major bankers in his library, refusing to let them leave until they agree to a coordinated response. It works, barely, but it takes weeks. Businesses collapse waiting for credit. Workers go unpaid. The economy contracts by 11% in 6 months. In a Senate hearing room 3 months later, witnesses describe the carnage. A Chicago grain dealer testifies that he lost his business because his bank couldn't access currency during harvest week. A Pittsburgh steel manufacturer explains how he laid off 400 workers when credit markets froze overnight. A widow from Philadelphia describes watching her life savings evaporate when her bank's clearinghouse certificates were refused by merchants who didn't trust paper promises. Senator Nelson Aldrich listens with barely concealed impatience. Aldrich represents Rhode Island, but everyone knows he speaks for Wall Street. He's been in the Senate 27 years. He chairs the Finance Committee, and he's heard this complaint before. The clearinghouses performed admirably under difficult circumstances, he says. The system is fundamentally sound. What we experienced was an extraordinary event, not a structural flaw. In the back of the hearing room, a slight man with wire-rimmed glasses takes notes in cramped handwriting. Carter Glass, Virginia representative, chairman of the House Banking Committee as of 6 weeks ago. Nobody pays him much attention. He's not a Morgan man, not a Bryan populist, just a small-town newspaper editor who somehow ended up in Congress. Glass reads every word of testimony. Then he does something unusual. He reads the previous panic reports. 1873, 1884, 1893, 1903. The pattern repeats with mechanical precision. Crisis emerges. Clearinghouses respond too slowly. Currency supply can't adjust. System freezes. Businesses fail. Workers suffer. Economy contracts. Then recovery. And everyone pretends the system is fine until the next crisis. That night, in his office, Glass spreads the reports across his desk. He's looking for something specific. Not the dramatic failures. Those are obvious. He's hunting for the invisible flaw, the mechanical defect that keeps producing the same catastrophic result. He finds it in the timing data. During each panic, there's a critical window, usually 72 to 96 hours, between the first major bank run and the moment when clearinghouse intervention could theoretically stabilize the situation. But clearinghouses need time to organize. Emergency meetings, member votes, certificate printing, distribution logistics. By the time they act, the panic has metastasized beyond containment. The system isn't failing because clearinghouses are incompetent. It's failing because the architecture itself contains no mechanism for rapid response. America's financial system operates like an army that has to hold a committee meeting before returning fire. Glass writes a single sentence in his notebook. The problem is not the institutions. The problem is the time lag between crisis and currency. Act 2. The Quiet Man Who Sees the Flaw, January 1908. Carter Glass's office, Washington, D.C. Glass is 49 years old. He learned the newspaper business setting type by hand as a teenager, worked his way up to editor, then bought his own paper in Lynchburg, Virginia. He came to Congress almost by accident. Local Democratic Party needed someone respectable who wouldn't make waves. Glass made waves. He exposed a local machine boss, got death threats, kept publishing. Now he's in Washington, chairing a committee that oversees the most powerful financial institutions in the world. They think he's a lightweight. He looks like a clerk, thin, pale, always slightly rumpled. He doesn't socialize with the banking elite, doesn't join their clubs, doesn't accept their favors. This makes him either dangerously naive or dangerously incorruptible. Wall Street can't quite decide which. Glass spends the first 6 months of 1908 doing something no previous banking committee chairman has done. He reads the technical literature, not the speeches and editorials, the actual operational manuals, clearinghouse procedures, reserve ratio calculations, correspondent banking networks, the invisible plumbing of American finance. What he discovers is a system held together by improvisation and institutional relationships that exist nowhere in law. When a rural Kansas bank needs currency during wheat harvest, it telegrams its correspondent bank in Kansas City, which telegrams its correspondent bank in New York, which physically ships cash via railway express, a process that takes 4 to 6 days if everything works perfectly. If there's a bottleneck anywhere in the chain, a telegraph failure, a railway delay, a New York bank that's temporarily short on reserves, the Kansas bank simply runs out of money and closes its doors. This happens constantly. Small banks fail every week, their depositors wiped out, and nobody in Washington notices because the failures are geographically dispersed. The system is dying from 1,000 cuts, but because there's no central nervous system to feel the pain, the body politic ignores it. Glass brings this data to Senator Aldrich. They meet in Aldrich's office. wood-paneled walls lined with oil paintings of previous banking committee chairmen. "We need a mechanism for elastic currency," Glass says, "a central institution that can expand and contract the money supply in response to real economic activity." Aldrich doesn't look up from the document he's reviewing. "You're describing a central bank?" "Yes. We don't have central banks in America. We tried it twice. Both times the institutions became corrupt, and the people demanded they be dissolved. Andrew Jackson killed the second bank in 1836. That's 72 years of settled policy. The policy is killing us. The policy is protecting us from concentrated financial power." Aldrich finally looks up. "Do you understand what you're suggesting? A central bank would be the most powerful institution in the country. It would determine who gets credit and who doesn't. It would control the entire money supply. And you want to hand that power to whom, exactly?" Glass doesn't have an answer. Not yet. Over the following months, Aldrich embarks on his own investigation. He takes a delegation of bankers and senators to Europe, studying the central banks of Britain, France, and Germany. They return convinced that America needs something similar, but controlled by private bankers, operated for stability, insulated from political interference. Glass reads Aldrich's proposal and sees the trap immediately. It's a central bank in everything but name, with governance weighted heavily toward Wall Street interests. The plan would create a single institution with 45 branches, its board of directors elected by member banks. Power would flow to the largest institutions. The old clearinghouse model, simply scaled up and given legal authority. The progressive wing of Congress erupts in opposition. William Jennings Bryan calls it a scheme to legalize the money trust. Populist newspapers run cartoons showing an octopus with Wall Street written on its head, tentacles wrapped around the Capitol building. The proposal dies in committee, and Glass goes back to his office, spreads out his notes, and starts over. Act 3. The unauthorized modification, July 1912. The Jefferson Hotel, Richmond, Virginia, room 318. Glass has rented this room for the summer, away from Washington, away from lobbyists and committee hearings and the endless pressure of political negotiation. He's brought one assistant, H. Parker Willis, a young economics professor from Washington and Lee University. For 3 months they work in near-total isolation. The problem Glass is trying to solve is architectural. How do you create a central bank that isn't centralized? How do you give America elastic currency without concentrating power in New York? How do you design an institution that can respond rapidly to regional credit needs, but can't be captured by regional interests? The answer comes from an unexpected source: the railroad system. America's railways don't have a single headquarters that controls every route. They have regional hubs: Chicago, Atlanta, St. Louis, connected by a coordination mechanism that allows through routing and standardized operations. Glass stares at a railway map on his hotel room wall for 3 days before the structure clicks into place. Not one central bank. 12. Regional Federal Reserve banks, distributed across the country, each serving a defined district. Each with its own board, its own reserves, its own operational autonomy, but connected by a Federal Reserve Board in Washington that sets broad policy parameters without controlling day-to-day operations. The genius is in the tension distribution. No single institution becomes so powerful it can dictate terms to the entire system. No single region can capture the mechanism for its own benefit. Wall Street gets a Federal Reserve Bank, but so does Kansas City. So does Richmond. So does San Francisco. And the core innovation, the piano wire hidden in the boom, elastic currency through the discount window. Member banks can bring commercial paper, real bills representing actual economic transactions, to their regional Federal Reserve Bank and exchange them for Federal Reserve notes. not gold, not government bonds. Paper currency, backed by the productive economy itself. When harvest season arrives and farmers need cash, rural banks can discount agricultural paper and get currency immediately. When the harvest ends and cash flows back to banks, the currency naturally contracts. The money supply becomes elastic, self-adjusting, responsive to actual economic need rather than arbitrary gold stocks. Glass writes the entire structure in longhand, crossing out sections, rewriting, refining. Willis handles the technical details, reserve ratios, rediscount rates, governance procedures. They work like engineers designing a bridge, calculating stress points, building in redundancy, anticipating where opponents will try to break the system. By September, they have a 200-page draft bill. Glass knows what happens next will determine whether this idea lives or dies. If he presents it as a complete proposal, opponents will tear it apart. Every interest group will demand changes. Wall Street will want more control. Populists will want less. The progressive wing will want public ownership. The conservative wing will want private governance. The bill will be amended into incoherence. So Glass does something that violates every norm of legislative procedure. He doesn't tell anyone the full plan. He presents different pieces to different constituencies. To Wall Street, he emphasizes private governance of the regional banks. To progressives, he emphasizes the public Federal Reserve Board. To rural interests, he emphasizes equal access to discount facilities. To Wilson's administration, he emphasizes political control over major policy decisions. Everyone thinks they're getting what they want. No one sees the full architecture. The bill enters Congress in September 1913. Glass testifies before his own banking committee, walking members through provisions one section at a time. Never the whole picture. Always the piece relevant to the questioner's concerns. A representative from New York asks about Wall Street's role. Glass describes the governance structure of the New York Fed. Private bankers on the board, operational independence, professional management. The representative nods, satisfied. A representative from Kansas asks about rural access. Glass describes the discount window, how a country bank can bring wheat paper and receive currency within hours. The representative nods, satisfied. A progressive asks about government control. Glass describes the Federal Reserve Board, presidential appointments, Senate confirmation, policy oversight from Washington. The progressive nods, satisfied. Nobody asks how these pieces fit together. Nobody realizes that Glass has built a machine where every part constrains every other part, where power disperses through the structure itself rather than concentrating at any single point. December 1913. The bill moves through final debate. Opponents attack from every direction. Aldrich's allies call it dangerous populism. Bryan's allies call it banker capture. Hard money advocates call it inflationary. Silverites call it a gold standard trap. Glass sits quietly through all of it. He's made dozens of small compromises on governance details, appointment procedures, reserve requirements. None of them touch the core mechanism, the 12 regional banks, the discount window, the elastic currency clause buried in Section 13. On December 23rd, the Senate votes, 43 to 25. The bill passes. Wilson signs it that evening. Photographers capture him at his desk, pen in hand, surrounded by congressional leaders. Glass stands in the second row, barely visible behind taller men. In the photographs, he's not smiling. He's watching the door, as if calculating how long he has before someone realizes what he's built. Act E. First Combat Test. November 16th, 1914. Federal Reserve Bank of Richmond. Opening day. The building is a converted warehouse. The vault still smells like tobacco. This used to be a storage facility for leaf exports. A dozen staff members, 2 typewriters, 1 telephone. The president of the Richmond Fed, George C., sits at a borrowed desk and waits for member banks to request their first discount operations. Nobody comes. Across the country, the other 11 regional Federal Reserve banks report the same experience. Banks have joined the system. The law requires national banks to become members, but they're not using the discount window. They still rely on their old correspondent relationships, their clearinghouse arrangements, their familiar procedures. Wall Street bankers call the Federal Reserve glasses folly. Editorial writers wonder if the whole structure will quietly collapse from disuse. Some economists predict the Fed will dissolve within 5 years, a failed experiment in government overreach. Then World War I provides the first real test. April 1917. America enters the war. The government needs to borrow unprecedented amounts, billions of dollars to finance military operations, ship supplies to allies, build a modern army from scratch. Under the old system, this would have required J.P. Morgan to organize a syndicate of private banks, negotiate terms, and hope they could sell enough bonds to cover the need. Instead, the Treasury turns to the Federal Reserve. The mechanism works like this. The government issues Liberty bonds. Banks buy them. Banks then bring those bonds to their regional Federal Reserve Bank and use them as collateral for discount window loans. The Fed credits the bank's accounts with new Federal Reserve notes. The banks use that currency to buy more bonds. The cycle repeats. Currency supply expands precisely to match government borrowing needs. No artificial constraints, no waiting for clearinghouse approval, no dependence on private banker coordination. The first Liberty Bond campaign raises $2 billion in 3 weeks. Old-line bankers watch this happen with growing unease. What Glass has built isn't just a lender of last resort. It's a monetary printing press that responds directly to economic demand, and it's completely bypassing the traditional gatekeepers. October 1917. Regional credit crisis in the Midwest. Drought devastates Kansas wheat crops. Under the old system, rural banks would fail, depositors would lose savings, and the region would sink into recession while waiting for the next harvest cycle. Instead, the Federal Reserve Bank of Kansas City opens its discount window wide. Banks bring whatever commercial paper they have, equipment loans, feed store credit, future harvest contracts, and receive Federal Reserve notes in exchange. The currency supply in the Kansas City district expands by 23% in 6 weeks. Businesses stay solvent. Workers keep getting paid. The crisis dissolves before it metastasizes into panic. In New York, a senior partner at J.P. Morgan & Co. reads the operational reports and realizes something has fundamentally changed. "They're moving faster than we can," he tells his colleagues. "By the time we'd have organized a clearinghouse response, the Fed had already injected liquidity. They're making our emergency procedures obsolete." Another partner dismisses this. It's a temporary wartime anomaly. When things return to normal, banks will return to proper correspondent relationships. But things don't return to normal. By war's end in 1918, the Federal Reserve has financed $21 billion in government debt, managed multiple regional credit crises, and kept the currency supply stable through massive economic disruption. The system Glass designed has passed its first combat test, and bankers are starting to whisper. ACT5, the Whisper Network and Wider Adoption, 1919-1923, the spread. It starts with small banks in agricultural regions. A banker in Nebraska mentions to a colleague in Iowa that the discount window saved him during a seasonal credit crunch. The Iowa banker tries it. Works beautifully. He tells a banker in Wisconsin. Word spreads through correspondence, trade association meetings, casual conversations, at regional banking conferences. The language they use is technical, almost coded. We've been experimenting with rediscount facilities. The rate structure is more favorable than we expected. Response time is remarkable. What they're really saying, the old way is dying. In the past, when a rural bank needed emergency currency, the process looked like this. Telegraph to correspondent bank in regional city. Wait for response, 4 to 12 hours. Correspondent telegraphs to New York. Wait for response, 6 to 18 hours. New York ships currency via Railway Express, 48 to 96 hours. Total time, 3 to 5 days. If the crisis couldn't wait, the bank failed. Now, the process looks like this. Bring commercial paper to regional Fed. Receive currency, same day, often within hours. The speed difference isn't incremental, it's categorical, like the difference between sending a letter and making a telephone call. State banks, previously skeptical of joining the Federal Reserve System, start converting to national charters specifically to gain access. By 1921, system membership has grown from 7,500 banks to 19,300. By 1923, it's over 10,000. The old correspondent banking networks don't collapse immediately. They erode. A bank in Tennessee that used to wire its New York correspondent for emergency currency now checks the discount window first. Faster, cheaper, more reliable. The New York correspondent doesn't lose the relationship entirely, but the most profitable piece, emergency liquidity provision, quietly disappears. In Chicago, the head of the Clearinghouse Association realizes they haven't issued emergency certificates in 4 years. The last 3 credit crunches resolved themselves before the clearinghouse could even call a meeting. The Fed is absorbing the shocks, he tells his board. We're becoming redundant. 1922. Bank of England internal memorandum. Meanwhile, European central bankers are paying attention. The memo's author notes something peculiar. American credit markets are behaving differently than British models predict. Seasonal volatility has declined. Regional crises that should trigger national contractions are instead remaining localized and resolving quickly. The American economy is becoming shock-resistant in ways that defy conventional monetary theory. British analysts tear apart Federal Reserve operational reports, looking for the mechanism. They see the 12 regional banks, the discount window, the elastic currency clause. On paper, it shouldn't work. Too decentralized, too vulnerable to regional capture, too dependent on local judgment calls. But it is working. A French economist publishes a paper arguing that America has accidentally discovered a new form of monetary architecture: distributed central banking. Power dispersed geographically, but coordinated functionally. The paper is largely ignored in Europe, but becomes required reading in American economics departments. The Germans send a delegation to study the system in 1924. They visit all 12 regional feds, interview bank presidents, examine operational procedures. Their report back to Berlin is bewildered. The Americans have built a central bank that operates through regional autonomy rather than central command. It violates every principle of Reichsbank design, yet their currency stability exceeds ours. By 1925, what Glass built is no longer experimental. It's infrastructure. Banks don't think about the Federal Reserve the way they think about other institutions. They think about it the way they think about the telegraph system or the railway network. Invisible until you need it, essential when you do. Act 6. Opponents collapse. October 1929. The crash. When the stock market collapses, old line bankers expect traditional panic. Bank runs, credit freeze, clearinghouse rescues, orchestrated by private interests. This is their domain. Crisis management is where the Wall Street elite prove their value. Instead, the Federal Reserve moves immediately. The New York Fed opens the discount window wide. Banks can bring securities as collateral, even depreciated stocks, and receive currency. The message is clear. Liquidity is unlimited. Don't hoard. Don't panic. The system will not freeze. It's not enough to prevent the depression. The economic damage is too severe. The policy response is too timid. The Fed itself still learning how to use its tools effectively. But the banking system doesn't collapse the way it did in 1907. There are bank failures, thousands of them, but not the cascading chain reaction that historically turned crashes into catastrophes. The clearinghouse model is finished. In previous panics, Wall Street's response followed a predictable pattern. J.P. Morgan, or his successors, would summon the heads of major banks to a private meeting. They would assess the situation, decide which institutions to save, pool resources, issue clearinghouse certificates. The entire process depended on personal relationships, institutional trust, and the willingness of powerful men to coordinate in private. That system still exists in 1929. But when the crisis hits, nobody waits for the clearinghouse meeting. They go straight to the Fed. The psychological shift is enormous. For 30 years, the banking elite operated on the assumption that they were the system's ultimate backstop, that their judgment, their capital, their coordination was what stood between America and financial chaos. Glass's design has made them redundant. J.P. Morgan Jr., son of the man who personally organized the 1907 rescue, testifies before Congress in 1933. A senator asks him if the banking system needs reform. Morgan's answer is careful, diplomatic, but the subtext is unmistakable. The era of private crisis management is over. The Federal Reserve has become the only game in town. What killed the old system wasn't regulation or political opposition. It was obsolescence. Glass built a faster machine. Once banks experienced discount window liquidity, instant, reliable, apolitical, they couldn't go back to the old model of telegraph negotiations and railway-shipped currency. The old way wasn't defeated, it was simply made irrelevant. 1933. Banking Act. Congress grants the Federal Reserve additional powers. Deposit insurance through the new FDIC, expanded regulation authority, direct control over reserve requirements. These are the visible changes, the ones history books document. But the fundamental architecture, Glass's 12 regional banks, his elastic currency mechanism, his distributed power structure, remains untouched. Because by 1933, it's not policy anymore, it's infrastructure. Trying to dismantle the Federal Reserve would be like trying to dismantle the national railway system. The economy has grown around it, adapted to it, become dependent on it. Glass, now a senator, watches these expansions with mixed feelings. He opposed deposit insurance initially, thought it would encourage reckless banking, but he recognizes that his core design is intact. The modification he installed in 1913 has become the load-bearing structure of American finance. In a private letter to a colleague, he writes, "They've added ornaments to the building, but the foundation I laid still holds the weight." Act 7. Legacy and Recognition. April 4, 1946. Lynchburg, Virginia. Carter Glass dies at age 88. The obituaries credit him with co-authoring the Federal Reserve Act. Some mention his long Senate career, his opposition to Roosevelt's court-packing plan, his fierce defense of states' rights. But most of the coverage is perfunctory. He wasn't a president, wasn't a famous financier, wasn't a household name. The New York Times runs 4 paragraphs, the Washington Post 6. Neither mentions the clause in Section 13. Neither explains the 12 regional banks. Neither describes the architectural genius of distributed power. What the obituaries don't mention, every bank loan issued in America that day passed through a system Glass designed. Every dollar of currency in circulation existed because of his elastic money clause. Every regional Fed bank operating across 12 districts was part of his architecture. By 1946, America has fought and won a world war, financed through Federal Reserve mechanisms. The discount window Glass created has evolved into the lender of last resort function that will define central banking for the next century. The regional structure he built has prevented the concentration of financial power he feared, and almost nobody remembers his name.